On today's episode, we are going to take a look at 6 companies reporting earnings this week. So let's get started. Like I said, today's episode, we are going to take a look at 6 companies reporting earnings this week. And those 6 companies are going to be Adobe, Lululemon, Chewy, Gamestop, Partycity, Dave & Buster's, and actually AMC. So actually we're taking a look at 7, and I'm not going to redo the intro. So even though I said 6, we're going to take a look at 7 companies, and pretty much we're just going to do a quick overview of the company. Most of them we're going to take a look at revenue growth in the past. We're going to take a look at their balance sheet and just what they're valued at. And then in certain companies, we're just going to take a look at a very quick look at them. And before we get started with the first company, don't forget to hit the subscribe button, the thumbs up, and the bell. It helps the small channel out so much, and I truly appreciate the support. And if you guys want to get in contact with me, make sure to follow me on Twitter. And I do have a Discord channel, which is free. It's no charge, and I usually I'm very active in there. I have my portfolios in there if anybody wants to come and take a look. And I have a lot of resources that I have used throughout my investing. And finally, before I go any further, guys, let me know in the comments which one you guys want me to do an in-depth analysis when earnings report. So if you're new to the channel, I normally go with a full in-depth analysis of a company pretty much every single day, especially when earnings are coming out. I pump out at least one video a day on a company. And like I said, if you guys want me to take a look at any of them when they report earnings, let me know in the comments. Some I'm really interested are definitely going to be Adobe, Gamestop, and Chewy are some I'm interested in, but I know other people might be interested in something else, so make sure to let me know. All right, so the first company we're going to take a look at is Adobe, and we're going to do a price review of how this company's performance have done since February 20th. And normally I have been doing February 20th because that's when pretty much the stock market started to tank. And for Adobe, since February 20th, this company has returned about 2% to investors, and that to me is actually kind of surprising, especially since Adobe has to deal with a lot of their software, Adobe Paint, Adobe Video, Adobe Reader, which I feel is items that are used pretty frequently, especially now with the working from home environment. So this was actually a surprise for me to see that kind of returns. I would have expected a bit more, similar to other stock software companies. So now let's take a look at this company's revenue growth for the past years. In 2019, this company grew 23%. In 2018, it grew 23% as well. And 2017, the revenue grew 24%. So this is a double-digit revenue grower, and that's pretty impressive, right? Especially for such a big company as Adobe, who has a market cap of $190 billion, right? $190 billion is one of the bigger companies we tend to see compared to the new growth stocks that are coming out. But with the over 20 growth revenue, I still consider Adobe a strong revenue grower, a growth stock per se. Gross margins for this company is 85% this most recent year, and profit margins were 26.4%. And that's, again, something you don't see with much growth stock. It has, with software companies, you do tend to see a very high gross margins, which we see 85%, but we are seeing also strong profit returns of a 26.4%. And again, I'm really already liking how Adobe is looking for the long term of things. Next, let's take a look at this company's balance sheet, and just a quick look. I'm not gonna go that much in depth. First, I just wanna add is quick cash, and that would be current investments in cash and cash equivalents. It's about 1.5 plus 2.7, so about $4.2 billion of quick cash. And this company has about $4.6 billion of non-current investment and 84 million of current debt. So this company definitely has enough quick cash to pay off any current debt anytime soon. So that's a good thing. Unfortunately, it doesn't have enough money to pay off its non-current debt, but non-current debt is debt that does not need to be paid off anytime soon. So it has almost close to a 1-to-1 ratio. And for me, this is definitely a strong balance sheet, especially since Adobe is already a company that's providing positive results. Next, let's take a look at the most recent earnings, which were on March. And March, they reported almost a 19% year-to-year growth, which is kind of similar to what we saw this company's annual revenue growth seem to be. I can't wait to actually see Adobe in this upcoming quarter and seeing how they're doing. But just like I said, I'm a long-term investor, so I can't really tell you how the price is gonna go up in the next 5 days, even in the next few months. But I do think in the long terms of things, Adobe seems like a good grower. Again, this is just me doing a quick overview of it, so there's still so much more I can look at it, but just from a quick top look of the company, it looks very, very strong. Now let's take a look at a quick valuation of the company, and let me zoom in for you guys. First, for a forward PE ratio for 2021, this company has a forward PE of 35. 35 might seem high to a lot of people, but remember, this is a company growing 20% and it has a decent balance sheet. Forward price to sales ratio is about 12.58, and that's actually pretty, I would consider that low compared to what we've seen, especially since this is a company that has 85 profit margins and about 25 gross profit margins. So in the long term of things, I am liking Adobe. All right, the next company we're going to take a look at is Lululemon, and they are an athletic apparel retailer. And in the past 6 months, this company has actually returned a lot to investors, and that's actually surprising. I thought an apparel company would not be doing good, but I guess more people just want to buy athletic apparel to be comfortable while working from home. This company has actually returned 21% to investors, and like I said, that's actually pretty crazy. I would have expected a company like Adobe to be providing stronger returns to investors compared to this company. So now let's take a look at this at Lulu's. And this is ticker LULU, and for Adobe was ADBE. And just if you're my podcast listener, make sure to give a great review for the podcast. It helps so much, and I truly appreciate you guys for listening. So revenue growth for Lulu in 2019 was 21%. In 2018 was 24%, and in 2017 was 13%. So it's not a strong revenue grower like Adobe. I feel like Adobe had more consistency in that high 20% revenue growth, but it's still definitely, I would consider for somewhat of a, I wouldn't consider this a true growth stock, but it's definitely close to there. Gross margins for this company is 55%, and this company has a profit margin of 16.2%. One thing I can take a look at is gross margins. Little by little, the gross margins have increased, which is good news. And same with profit margins. Every year, the profit margins tend to increase little by little. Next, let's take a look at this company's balance sheet. And in the most recent, this company had about $1.1 billion of quick cash. Current debt, this company had about 125 million, and in non-current, this company had about 611 million. So it has a total of about 750 million dollars of debt, and it has plenty of cash to pay off. So this company has a little bit stronger balance sheet than Adobe, and I'm pretty sure this is going to help this company. This is helping the company make sure it's not going to go bankrupt anytime soon. In the most recent earnings, this company saw a 20% increase in revenue, which is kind of similar to what we see in the previous year. So that's actually pretty good. And if we take a look at valuation, this company's forward PE ratio is 52, and its forward price to sales ratio is 8.46, right? And what are we getting with Lulu? With Lulu, we're getting a company with strong balance sheet. We're getting a company growing still pretty strong, right? We see some 20%. The most recent quarter was another 20%. And we're seeing a company that is profitable with good margins, and margins that are improving. But to be honest, even though I can't compare this between Adobe, if I was to choose one company right now, it would definitely be Adobe over Lulu. All right, the next company I want to take a look at is Chewy. And Chewy, they are pretty much a pet supplier retailer, and this company since February 20th has returned a strong has returned 65% to investors, right? And this is one I can honestly understand why it has gone up. With people working from home, they're spending more time with their pets. They're probably buying them more toys, more food, and just are spending, like I said, more time with their pets. So they're increasing their spending on pets. Let's start with this company's revenue growth. And in 2019, this company's revenue grew 37%. In 2018, it grew 67%. And in 2017, it grew 133%. So yes, even though the revenue is decreasing, just this past year was 37.19%. And expecting with COVID-19 that this quarter will be really, really strong for them. Let's actually try to look at their most recent earnings, which were in April. This company's total revenue went up 35% compared to same time last year. Now let's take a look at this company's margins. And here in 2019, we can see, the first thing I can see is gross margins for 2019 were 23.6%. They have been improving throughout the past 4 years. That's one thing. We do see an uptrend right here. Profit margins, unfortunately, this is a company that is not providing returns yet to investors in positive earnings. But with this company's growth, right, we saw for 1 year 130, another one 60%, and the most recent was 30%. Normally with companies like this, they're spending more money right now trying to grab more customers and trying to increase their revenue, and then they'll start building up that profit margins. Now let's take a look at this company's balance sheet. Normally with companies like this, you would expect them to have a very, very strong balance sheet. This company, look, $200 million of non-current debt, and this company has $212 million of cash and cash equivalents. To be honest, it's not as nice as I want it to be. I still think out of all of them, Lulu probably had the best balance sheet right now. But like I said, I was expecting a bit more, so I'm a little disappointed there. Now let's take a Chewy's investment. Let's take a look at their valuation. Their forward price to sales ratio is 2.51. And you'll be like, 2.51, Jose, that's actually a lot cheaper than Adobe, a lot cheaper than Lulu. But remember, here you're paying for a company that's it's not profitable yet. Gross margins are only about 20%. Even though they're growing, revenue growth is still there, but the balance sheet is not as strong. And even when this becomes profitable, I wonder how profitable those margins are going to be. So that's why sometimes it might look cheaper when you take a look at something as simple as forward price to sales ratio. But when you think of it in how other companies compare, you can see why certain investors might pay a little bit more for certain companies compared to others. All right, so the next company we're going to take a look at, and every company from here are companies that I feel have been very, very heavily affected by COVID-19, and it has a lot of investors worried. The first one is Gamestop, and compared to February 20th, this company has returned literally 0% to investors. At one point, it was up about 43%, but right now it's sitting at about 0% return compared to February 20th. And one of the main reasons is just 2 days ago, this company expected quarter sales to plunge about 33% compared to same time last year. I mean, even though games are up right now, I think most people are probably just buying digital games opposed to going to GameStop and actually purchasing the games from them. Let's just take a quick look at this company's balance sheet. This company has non-current debt of about $950 million and has current debt of $239 million. And this company only has cash of about $500 million. So that to me is not a strong balance sheet, especially if this revenue quarter they're expected to see a 33% decrease. So I can see why this is pretty scary for investors. And to be honest, I did expect this to actually be down more than what it is, right? Flatline compared to February 20th is actually not bad. Next, let's take a look at AMC, the movie theater. And the big news for AMC is analysts are saying that it's very close to the possibility of a company being bankruptcy. Movie theaters have been closed for such a long time right now. And I can't imagine how many people are waiting to go back to the movies. There might be a certain amount of people, but with the amount of restrictions of capacity, is definitely going to hurt this company even when things open up. Since February 20th, this company has returned has actually declined 23%. But one thing I did notice, if you picked up at the bottom, you're almost up 200% on AMC. So congratulations to everybody who picked up at the bottom. But let's take a quick look at this company's balance sheet. This company's revenue is going to be hit so big since this company did close down every theater due to COVID-19. This company has cash of about $275 million, and it has non-current debt of $9.7 billion and current debt of $660 million. This is one of the worst, and I'm sorry if you're an investor, but just to me, right, I could be completely wrong, but this is one of the worst balance sheets I have ever seen, and I can see why this company is so close to bankruptcy. It's actually too close to call. The next is Dave & Buster's, and Dave & Buster's since February 20th has gone down about 60%. And to be honest, to me, Dave & Buster's, I do think that people are more willing to go to AMC than Dave & Buster's, because if you go to AMC, you actually sit in your own seat and you don't have to touch many things. But Dave & Buster's, if you don't know, it's like a Chuck E. Cheese for adults with all the games there and all the arcades. People are going to be touching everything. So I do think this is actually going to hurt Dave & Buster's a lot more in the long terms of things, even when they open up, right? You're not going to want to touch everything. Are you going to go to Dave & Buster's wearing gloves and trying to not touch your face during the whole time? So this to me is one of the companies I can understand why it's down so much. If we take a look at this company's balance sheet, this company had, I can't believe it. How much cash did it have? This company had $24 million in cash, and it had any current debt, $15 million in current debt, and about $2 billion in non-current debt. This company at least has enough cash to pay off its current debt, but in the long term of things, this is definitely another bad balance sheet in my opinion. The final company we're going to take a look at is Partycity, and Partycity is down about 40% compared to same time compared to February 20th. But if you picked up at the bottom, you're up almost 500%. So that's actually pretty insane. Partycity's balance sheet right now has about $34 million in cash, and it has about $355 million in current debt. Again, another company that's balance sheet is not that strong, especially with what they're experiencing right now. These are four companies that, yes, they have gone down a lot because of COVID-19. And if you picked up at the bottom, you have had great returns. So congratulations. But in the long term of things, I wonder how COVID-19 has truly affected this company. So I hope you guys enjoyed today's episode. Like always, make sure to subscribe, make sure to hit the thumbs up and hit the bell. Let me know if you guys want me to do any of these stocks full depth analysis when earnings report. Just let me know in the comments. So take care, guys. Have a good night and see you next time.